With the name of Allah. This is the lecture number 6 in Management Accounting Principles for the third year Faculty of Commerce. I will continue in this lecture how to prepare budget for planning and control. The master budget is a comprehensive financial plan. It's divided into operating budgets and financial budgets. We had studied operating budget and now we'll study financial budget. Financial budgets include cash budget and capital budget. In this lecture we'll study cash budget. The definition of cash budget. A cash budget is an estimation of the cash inflows and outflows for a business in a specific period of time. Cash budget include cash inflows and cash outflows. Cash inflows mean the money you will gain in the next period, and the cash outflows mean the money you will pay in the next period. Therefore, the source of data for the cash budget are expected cash receipts and expected cash payments. In more details, expected cash receipts are receipts from sales, receipts from accounts receivable, or receipts from other revenue, for example commission, interests, and so on. On the other hand, the expected cash payments or cash disbursements are raw materials, payroll, other direct expenses, advertising, selling and administrative expenses, and plant and equipment. Now we can take an example. In the first example, I will explain only expected cash receipts. Example 1. A new company has projected sales, all credit sales as follows. Month from July to October, sales revenue 100,000, 150,000, 220,000, and 200,000. It's assumed that 70% of each month's sales will be received 1 month later, and the remaining 30% in the following month. That's mean 2 months after the sale. Kindly look at July. Sales revenue 100,000. The company will receive 70% from 100,000 in August, and the remaining 30% from 100,000 in September. Required. Number 1. Prepare a cash budget for the month of July, August, September, and October. Number 2. Determine the accounts receivable amount at the end of October. The solution of example 1. Draw a table with 5 columns, data July, August, September, and October. Under data, receipts from sales. July 100,000, August 150,000, September 220,000, and October 200,000. After that, total receipts from sales. In July, sales revenue 100,000. This amount will be received as follows: 70% in 1 month later and 30% in 2 months later. Kindly look under the table. 100,000 times 70% equals 70,000. This amount will be received in August, and 100,000 times 30% equals 30,000. This amount will be received in September. The same as in August. In August, sales revenue 150,000. It will be received as follows: 70% in 1 month later in September and 30% in 2 months later in October. Kindly look under the table. 150,000 times 70% equal 105,000 and 150,000 times 30% equal 45,000. The sales revenue in September is 220,000. Kindly look under the table. 220,000 times 70% equal 154,000. This amount is 70% from sales revenue. What about the remaining? What about the 30% of sales revenue? The remaining will be received in November. That means it's the ending balance of October. The sales revenue of October is 200,000. This amount will be received in November and December, so this cash budget has no receipts from October sales. The total receipts from sales are 0 in July, 70,000 in August, 135,000 in September, and 199,000 in October. This is the solution of required number 1. Required number 2. Determine the account receivable amount at the end of October. To determine the account receivable amount at the end of October, you can calculate it as follows. Part of September sales, the 30% of 220,000 equals $66,000 plus all of October sales, 200,000. The total is the total accounts receivable, 266,000. This amount will be the account receivable in the budgeted balance sheet at the end of October. I will continue cash budget in the next lecture, inshallah. Goodbye.